lot of people have questioned, how do we avoid Division 296? And there's no real way to avoid it unless you start transferring assets outside of super into family trust or insurance bonds. When you're making contributions to your fund, when it's over $3 million cap, you can speak to your advisor about when you make contributions to the fund. It may help you with some tax planning strategies for Division 296. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services, and over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. G'day guys, and welcome to this edition of SMSF Insider. Today, I just wanted to briefly touch on Division 296. I know it does only affect a very small percentage of the population, but I did want to touch on just how it is actually calculated. So what happens is at the end of the financial year, so June 30, the assets are calculated. So for example, if your fund balance is 3.1 million at the start of the financial year, or June 30, 2025, for example, or 2026, we fast forward to the next financial year. So if it's June 30, 2026, then we roll forward to June 30, 2027. We revalue the assets at that point. If it's gone from 3.1 to 3.5, for example, there's $400,000 growth during that period. So what we do is we take the amount over 3 million, which is 500,000. So we go 500,000 divided by 3.5 million, which is 14.28 or 29%. Then we multiply the amount over 3 million, which is 500K, times it by that percentage, 14.29%, which equals 57,160. You then multiply that by the 15%, which equals 8,574. Sounds a little bit convoluted, but when you write it down, it does make a little bit more sense. So I just wanted to briefly touch on how Division 296 is actually will be calculated. When we talk about Division 296, obviously, as I previously mentioned, it does affect only a small percentage of the population currently, but with some of the assets and how they'll be calculated. So with direct equities or shares, for example, it'll be very easy to calculate because we know exactly what that share is worth at June 30 at the end of the financial year. With unlisted assets like property, for example, then you've got to get them valued, and that's can sometimes be a little bit more subjective in terms of what property is actually worth, because at the end of the day, it's only worth what someone's willing to pay for it. Property may be a little bit more difficult to calculate or value because it is a little bit more subjective. And the other thing as well is when you've got assets inside of an industry fund or a retail fund, they will automatically be calculated for you. Whereas if you've got an SMSF, you can be a little bit more creative, I guess, in terms of when the asset's valued, when you're making contributions to the fund, to help you navigate around, not avoid Division 296, but it may help you with some tax planning when you do have an SMSF as opposed to an industry fund or retail fund. So bear that in mind if you do have a larger balance, and you are in Division 296 will be affecting you, then get in touch with an advisor. Maybe an SMSF might be the right choice in terms of tax planning strategies when that does come into effect. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode. So when we are talking about valuing unlisted assets like property, it's very similar with the industry funds that hold big commercial assets in the CBDs. They actually, to calculate their earnings, they need to get these properties valued. So it is, I guess, a little bit easier for an industry fund to say, okay, well, last year the building was worth 50 million. This year it's worth 55 million. So we've made a 10% capital gain. So essentially they're writing their own gains because they're unlisted assets and they're not listed on the exchange, so you can't see what they're worth on a particular date. It is a subjective valuation at the end of the day. So it does become easier for these industry funds to essentially write their own returns. just talking about Division 296 once again, it does affect only a small percentage of the population, but we'll just touch on contributions because, you can, when you're making contributions to your fund, when it's over the contribution, or when it's over the cap, the $3 million cap, you can speak to your advisor about when you make contributions to the fund. So timing your contributions into your SMSF or your super fund in general may help you also navigate and help you with some tax planning strategies for Division 296. So reach out to your advisor and they'll be able to help you with regards to when you should make contributions to your super fund to help you with Div 296. A lot of people have questioned, how do we avoid Division 296? And there's no real way to avoid it unless you start transferring assets outside of super into a family trust, or insurance bonds is another one that you could speak to your advisor about. So essentially an insurance bond is an investment vehicle where you can invest on an annual basis. And after 10 years of being in the insurance bond, all of the gains are actually tax-free. Or they're actually taxed internally. So reach out to your advisor. Once you do get over $3 million, you could potentially start to invest. Instead of making additional contribution to your super fund, you could invest potentially in an insurance bond or something like, or a vehicle like that, which does have the tax advantage of being tax-free after that 10-year period. So reach out to your advisor and they'll be able to help you with some tax strategies for 296 once you do get over that $3 million cap. So that's it for Division 296 and how it's calculated. Feel free to drop some comments in the comment section below should you want us to talk about any specific topic moving forward. Thanks for tuning in. I'm Troy from Blue Chip SMSF Insider. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF or book a call with our team to see if we can help you.